Welcome to the Startup Grind.
Without further ado, I'm going to bring up Rudy Gadre, angel investor, prolific angel investor. Come on up, Rudy.
I feel like I should sing single lady songs.
Sing it.
So,
Turn it on?
that's it. Is that it on the list?
Yeah.
Are you good?
You're on.
Okay, great. Thanks, Nick. Nick is the extraordinaire. He runs the event search at Dice Quinn. So, thanks, Nick.
All right.
So, what's your name? So again, for the people that have not been here before, and also, Haley, can you hear me back there?
I can, yes.
Okay, thanks. So for those of you who have not been here before, this is really truly a fireside chat. I'm gonna, I'll ask questions, and I've got, 4 sheets of them. Some of you have actually sent me some of these questions, and I'll ask Rudy. He's been kind enough to say he'll answer anything we ask him. And then we'll open it up for the audience about, last 15, 20 minutes. So hold your questions till the end, and I'll announce that to say, hey, free to open questions. So, this is a fireside chat we're going to have, and he hopefully won't lie to us.
Only if it's good for you.
Okay. So let's just start off. I know you're a huge Seattle fan. You talked about it a lot.
Yep.
Why is that?
Well, I'm from here. I was born here, and so I love the city. I love Seattle. I was down in the valley for a few years working for Facebook, and honestly, I didn't like it that much, and I wanted to come back. And I think there's a lot of untapped potential in Seattle. I think that there's a ton of ingredients that could make this a world-class destination for innovation here in Seattle. And I think that combined with my roots here have made me really passionate about supporting the local scene.
So you went to high school here, went to college in Pennsylvania. Why that?
I want to get as far away from Seattle. When you're 18, you feel different than when you're
So you just picked that.
Well, I was a good squash player, and Franklin Marshall College, where I went, was a good squash school, and so that made sense.
And when you were growing up, did you want to be in the tournament?
I did. Yeah, I was a very argumentative kid, and so it seemed like being a lawyer would be a good fit.
Okay. And what was the first dollar you earned that was not from a relative?
First dollar I earned not from relative. It's interesting. It's probably when I was young, maybe 14, 15. I lied to Nintendo about my age to get a job as a game tester, and it was a summer job, and it was freaking awesome. They didn't pay anything, but the job title was through the roof, right? You're a 15-year-old playing video games for a summer. I'm like, it's like the score, But unfortunately, I had to go back to school after that.
So you actually had a real job.
Yeah, sort of, but game testing is a real job.
And you went to UW for the law degree. Why? You just want to come back then?
My parents cut off the funding, so UW was a lot cheaper than the other options, in-state public tuition. So.
Yeah, there's always a simple reason, right? And your first job was Perkins Group?
Yeah, out of law school, my first job was Perkins Group. I worked there in the technology business group in Bellevue for about 5 years. Back then, and I started out as a technology lawyer back when that was software licensing. Before the internet, essentially, not before the web, anyways. And so, I was there for about 5 years, through the start of the dot-com bubble, and then jumped ship with Amazon.
Well, so I'm gonna, you can correct me where you want, but Rudy has been, he's invested well over 50 companies, probably close to 60 now.
70, yes.
70, yeah. So a lot of angel investing he's done. He was lucky enough to be at Amazon fairly early on. Be at Facebook, the top first 50 maybe?
Yeah, 46.
Yeah, so he's been lucky enough to be with a couple large companies that has done well. So a bit of background. Why be an angel investor? It's not like you probably didn't say, hey, I'm going to be an angel investor.
Sure.
Probably like, why, how did you fall into that?
Yeah, well, so, I moved back up here in 2008, partly because my father was, had a serious illness, and we had a son, and so it's time to move back. And so, I helped see my father through the terminal phase of his illness, got my mom back on her feet, and it was around, middle of 2010, and then by the time I had, sort of gotten everything settled down, Facebook stock was trading in the private market at a sufficient valuation that I didn't have to go back to work. It was a nice problem to have. And so I didn't go back to work, and then I was sort of sitting on my couch because nobody gives you, a game plan for what you should do when you're, retired relatively young. Which is not to say it's a bad thing, but it's, you got to figure out what to do with yourself, and you can only watch so much Oprah. So, I started to do a couple of friends and family deals. People were, hey, I heard you made some money at Facebook, want to put the money in my company? Sure, why not? And then it kind of occurred to me that angel investing was a good way for me to stay, mentally sharp. I get to see all kinds of interesting people doing interesting things. I can support the local community. I can hopefully, spur some great innovation in Seattle, and hopefully make some money while I'm doing it. So it all kind of came together for me, along those lines. And then also, I got some good advice from one of my old colleagues at Amazon, Kim Rackmiller, who had retired some years previous, and what she said was that, there are two things you should optimize for. So one is happiness in your life. So you're enjoying the thing you're doing. That could be golfing or playing video games, whatever. But you should also optimize for happiness with your life, so that when you look back on it 30 years later, you feel like you did something good. You didn't just waste your time. And so, angel investing sort of fit both of those criteria for me.
Yeah. And what was your biggest learning experience becoming an angel investor? It's not. It's a risky business. It's not like you win every time you don't.
Sure.
But tell me, what was your biggest thing that you had to learn or learned along the way? It's like, wow, this was the thing that I really realized that was important to know.
Well, it's hard to say. You mean in terms of being a successful angel investor? Or just, life lessons?
Versus being an unsuccessful angel investor.
Yeah.
Being successful.
Yeah, there's a number of important lessons that I think any angel investor, needs to internalize, and you can hear them, but until you feel the pain of losing money, you don't really buy it, But, a lot of it is you really do need, at the early stage, the team is by far the most important thing, because, the idea can change, and, the competitors can change and all that, but the team, you have to believe that they will, be the team that can find their way through all the, all the twists and turns of making this thing into a successful startup. Yeah, so the team is by far, the most important thing. One other thing that, novice angels, I think, should think about is, it's very easy when you hear an idea, like anytime you hear an idea, if it's at all plausible, you're like, oh, cool, like this is awesome, like you think about what I can do with this thing, right? But in reality, like what you need to think about is how could this thing go wrong, right? Because, everything could happen, or everything is plausible, and you can imagine what I can do with this thing, but, what you really need to think about before you write your check is, okay, where is this thing going to fall down? Like, where are the failure points? Because then that gives you a much more realistic picture of, okay, even though it could be cool, it's probably not going to make it for various reasons.
And in your experience, what do you think has been, what's made you successful, Rudy successful versus Jeff Interest or whoever, or maybe some investor that hasn't been as successful as you? What's been your USP?
Yeah, well, Jeff is probably more successful than me, so I know he's not a good example necessarily. But I think that a lot of it is just you got to get out there, and a lot of it is elbow grease. You just got to meet a lot of people and hear a lot of ideas and develop your own philosophy. And so, people who sort of dabble in it are, almost by definition less likely to be successful than people who make a full-time career out of it. And so, now I guess I'm a small-time venture capitalist, but when I was an angel, I was essentially doing it professionally, right? And so that, I think, is what sort of differentiates investors to some extent, like how much you commit yourself to it.
Sure. Yeah, just like being in part-time jobs.
Right. Yep.
What part of working with the founders do you like?
Yeah, the enthusiasm is great. That's one of my favorite people. You get to see people who they're hungry and their eyes are bright and they want to change the world and they're willing to, burn the boats to do it. And that enthusiasm is infectious, certainly. And then, especially, it's fun at the seed stage because you're not bogged down in corporate stuff and like operations and logistics and stuff. Like you're really sort of trying to figure out how can we do something that's just going to change, the way business is done. And most of the time it won't work, but the times when it does work, it's just an incredible rush, to see that coming to fruition. Like, I really enjoy that. So.
Yeah. And 70 investments, Rudy. I mean, how do you manage that? I mean, how do you?
Yeah, not very well.
Yeah, exactly. It's like, you can't talk to all these people every week.
Yeah.
How do you do it?
Yeah, I mean, the way it works is there's sort of a bell curve of anything, right? And so at any given point in time, out of those 70 investments, maybe 10 will need some help. I can introduce them to somebody, or they need strategic advice, or I can, help with funding or whatever, And so those 10 kind of cycle through. So, I essentially triage, and I focus on the ones that need help right now. And then as those cycle out, somebody else cycles in. And so I just sort of focus on, and the ones that don't need help, I assume they'll call me if they need help. If they don't call me, then I'm not calling them,
So it's that cycle of, is it the ones that, I guess, scream the loudest, obviously, are going to be helped first?
Yeah, and if I genuinely perceive that I can help, right? I mean, if you're screaming and there's nothing I can do, then there's nothing I can do. But if there's something I can help with, then the ones that look like they need the most urgent help are the ones I'll focus on.
Yeah. What was it like working when you came back? You worked with Every?
Yeah.
So that was what brought you back to Seattle.
Sure. Well, my father was ill, as I
Yeah.
mentioned, and then we had a son right at the same time my dad was diagnosed, and so that was sort of time to come back. But I had a friend, Neil Roseman, who I worked with closely at Amazon, who was the CEO of Every, and he was like, "Dude, I need a VP of operations, somebody to help steer the ship." And I said, "Sure." I didn't have a job. I didn't need a job per se, but Facebook stock was not yet sort of at the ridiculous valuations you see today. And so I said, "Sure." And I went to work there for about a year and a half maybe. But it was sort of to help Neil, and it was an interesting idea. It was Paul Allen wanted to rewire the way the web was consumed. It was some interesting stuff.
Yeah. And what keeps you motivated each day?
Yeah, it's I think it's the intellectual stimulation that I get really from interacting with all these enthusiastic, intelligent, motivated people. I'm not even doing it primarily for the money, right? I mean, money would be great, but if I don't make money, now as a venture capitalist, of course, I need to make money for our investors. But as an angel, I wasn't as focused on driving 10x returns and things like that. It was more one, I want to help Seattle. I want Seattle to thrive. I want Seattle to be a great place for innovation. And two, I just really it's like my hobby. And so where other people might have bought boats or cars, I put money into startups because that's what I enjoy.
Yeah. And how do you stay abreast with new technologies? I mean, do you read blogs? How do you keep up the speed? I mean, because it's flying at you, I'm sure, pretty fast.
Yeah, I read the tech press, of course, Tech Meme and GeekWire and all the various trade rags. But a lot I just get pitched on so many deals. I see 10 deals a week, and so it sort of comes to me, right? I mean, whatever people are doing, I see some flavor of it at some point. Yeah. So.
Yeah. And why the recent partnering with Chris and Andy? So recently, Rudy joined co-founders
Founders Co-op.
Founders Co-op, and are you a partner there?
Yes, I'm the third one.
Yeah. So I'm sure you guys have already done deals before then. But,
I was an LP in the second.
so why the move to join these guys?
Sure. I mean, part of it was the scaling issue. At 70 deals. So my background at Amazon and Facebook was consumer internet. So that's what I know, and that's what I feel like I have expertise in. But I frequently get pitched on other kinds of deals, enterprise deals, and things of this nature, where I know something about it, but enough to be dangerous kind of thing. But I don't really feel confident. And now with 70 deals sort of in the hopper, I don't really have time to get up to speed on every deal I get pitched. Whereas Chris, for instance, has a lot of competency in the enterprise, SaaS, cloud kind of stuff. And so now I'm a partner. So when somebody comes to me with a deal like that, I'll be like, talk to Chris, and likewise, he can refer consumer deals my way. And part of it for me, what I'm trying to do, my overall philanthropic goal is I want Seattle to have a thriving ecosystem. And so, as an angel, if I make money, I'll make money for myself and maybe for my syndicate that I pull into a deal, but that's a relatively small pool of people. Our LP base at Founders Co-op is largely composed of Seattle investors. And so, if we can get some wins at Founders Co-op, my hope is that, the people in Seattle who have invested in our fund, all of a sudden 60 or 70 people make some money. Hopefully those people will be like, hey, this is there's potential winners here. We'll plow some more money back into the ecosystem. So, as a partner in the fund, I can have a lot more leverage in terms of my impact on the local scene than I can as an
By
individual.
yourself, yeah. So let's talk a bit about that, the fact that, what do you think what's the driving factor? Why don't, the Amazonians put money back into the ecosystem? What's your theory behind that?
It's hard to say for Amazon. I do have a theory for Microsoft, which is that, Microsoft in some ways was never a startup in that the Windows monopoly sort of caused the company to go like this without going through all the weird ups and downs that most startups do. And so, people who came from that background, I don't think entirely, and especially now because it's been so many years, entirely grasp the sort of startup mentality and what it takes to get involved at the early stage, And so at Amazon, I've been disappointed, honestly, in the lack of participation because there's a ton of smart. I worked there for 7 years. I know lots of people there, and I think the participation we've had from Amazonians, both on the funding side and the entrepreneurship side, has been disappointing to me. And I have a theory that at during the .com bust, when a lot of the early Amazon employees would have been out founding companies, they couldn't get funded because there was no money.
There's no money. Yeah.
And then by the time the economy had recovered, it was kind of too late for them. But Amazon was then big enough that the people who got there later, they're more pioneers, they're more settlers than pioneers. But now actually, I'm starting to see at last. It's a lot of people who will do like 2, 3, 4 years at Amazon and then peel off and do a startup. So it's not really the old guard who are out there in the startup community. It's people who do sort of an internship at Amazon and then go do something else, which is great.
Yeah.
I think that's terrific. So.
Yeah. And what do you think about the conservative viewpoint or conservative style that is kind of an angel investor, Seattle angel investor versus, you were down the valley, it's different, obviously. Tell us how you think how that could change. First give me an opinion about why it is so conservative, and then say, give me something like, why do you think that could change, and how could that change?
Sure, well, so the reason I finally come to what I believe is the difference between Valley companies and Seattle companies. Valley companies assume that there will be money, that you will get funded in the next round, right? And so passionate about the mission. That was sort of the fun part of it, and also the thing that saved the company in the long run.
Where do you think that's going to go?
Amazon? Yeah, it's hard. Jeff is just like found that the company is going to continue to innovate. There were a number of things. Like when I left in 2005, we were just about to come out with the Kindle. I was like, really? We're doing a hardware book reader? Does that make any sense at all? And I was like, but I've learned, over the years that Jeff sees things that I just don't see. He's got vision, and so people just roll with it. And so as long as Jeff is at the helm, I think they'll continue to surprise and continue to do sort of out of the box creative stuff, and just hold a lot of rabbits out of a lot of hats, and so people give them the benefit of the doubt now. So.
Yeah. In your maybe evaluation and how you look at things, are you more technical or are you more technical or are you more business oriented? Are you looking at the technical pieces, or are you looking maybe more at the culture piece of the business? When you're looking at companies, what's your kind of thing?
It depends on what kind of company it is, right? If you're solving some very cutting-edge technical problem, then of course you need to feel like the team is very strong on the technical front. If it's business, probably like a marketplace, right? There's probably no whiz-bang rocket science to building a marketplace, but there you're focused on the business inputs and can they build liquidity on both sides of this marketplace and things like that. So I'd say it varies from company to company. But the things that don't vary are you're looking at the team. Are they the right team for this opportunity? And do they and then the market opportunity. How big could this be if it's successful? Those are the things that you mainly look at.
Yeah, I think one of the things you've talked about many times is you're looking for opportunities that have a big opportunity, not $25-30 million, but you're looking for big opportunities.
Yeah.
Give this room's full of entrepreneurs.
Mm-hmm.
Give some pieces of what a big opportunity is.
Sure. It's something that, first of all, you can make a lot of money. There's a big addressable market in terms of the dollars that are being spent or the dollars that are potentially being spent. It can impact a lot of people, and typically if you impact a lot of people, then you're going to make a lot of money, right? And that's sort of the Facebook and, Google style, build something incredibly useful to a bunch of people, and then you almost certainly can monetize that on the back end. So, either of those two things, I think, can work. Either that this thing is a money machine that turns nickels into quarters, that can be great as long as there is a lot of quarters to be had in this market, or this thing is just going to impact so many people so deeply that, it's just going to change the world. Yeah, right, and then, and then you can always monetize that. So.
Yeah. Is there a number when you're talking to potential founders that says, well, I'll continue the conversation?
A number for?
Like, evaluate, like, what they're talking about, like, in revenues, and, because everybody gets the hockey stick.
Yeah.
Like,
No, I mean, I just have to believe the market. At the seed stage, it's so hard to tell, and honestly, the product will change between now, and so, no, I just have to be convinced the potential for the market size is above a certain threshold, and then beyond that, I don't get into it too. I don't care if it's 10 million or 50 million. 10 million is plenty, right?
Yeah.
Kind of thing, so.
Yeah, because it's probably not going to be what it is today.
Right.
Yeah. Is there such a thing as work-life balance in a startup?
There shouldn't be, It's the unfortunate reality, and this is much more a Valley mentality than a Seattle mentality, although, certainly Microsoft in the early days and Amazon in the early days, we worked like crazy, But it's, it's tough, right? The startup is a real commitment, and, you're doing every job, you're wearing every hat. If there's a team of 3 people, there's nobody to delegate responsibility to when you want to do a water skiing on the weekend. I mean, someone's got to keep the site running, and someone's got to make sure those deals are happening and all that kind of stuff. So, the startup is not for everybody, and it takes a lot of commitment. And honestly, if I'm going to invest in a startup, I want the founder to be burning the boats. Like, we are not turning back, no matter what, And so there's, the startups that I've seen succeed are the ones where, people are 100% committed, and we're going to make this thing happen no matter what, and we'll run through a brick wall if that's what we have to do. So, it's hard, if you want work-life balance, a startup is probably not the best place to do it.
Yeah, yeah, work 9 to 5.
Right.
Probably should pick another idea.
It's a big thing these days, and there's a lot of interesting applications there. Robotics is going to be big, drones and robots of various sorts. Cloud stuff. In Seattle, there's a lot of gaming. Those are obviously big deals here locally. I'm generally a believer in marketplaces because I think the internet is very good at creating liquidity. Essentially, the internet gets information from where it is to where it can be more usefully used, right? Which is the essence of all social networks and marketplaces. Facebook gets your photos off your hard drive into grandma's hands where she can enjoy them, and eBay gets that poster out of the shopping Greenwich Village into somebody's house in Seattle. And so so the internet is really good at that, and I think there are still a ton of industries, especially with the rise of mobile, that the marketplaces will continue to make more efficient, like Airbnb and Uber and that sort of thing.
Yeah. So you're a fan of the marketplace having 2 inputs?
I am, yeah. I mean, well, at Amazon, we had to compete against eBay, so I learned a lot from that side. And then at Facebook, of course, it's sort of a canonical network effect business, and so I learned a lot there.
Yeah. And what do you think, talking about that marketplace business model, what do you think is the challenging, you've obviously seen a lot of those deals, what do you think has been a challenging piece for those guys that are starting those companies, in that marketplace scenario? You got input A and input B, you got to manage that?
Yeah, there's only one thing that's important to a marketplace of liquidity. How much supply do you have, or how much demand do you have? You need to be able to aggregate one of the sides of the marketplace in order to attract the other. And so, the only times I will invest in a marketplace is if I feel like the founder has some edge in terms of building liquidity on one side or another of the marketplace, and then marketplaces sort of leapfrog, so the demand will go like this, and then supply catches up, and then demand comes, they never rise in
it's never perfectly even.
So I mean, by far the hardest problem in any marketplace is finding a way to build liquidity on one side, because sellers don't want to come unless they're buyers, and buyers don't want to come unless they're sellers, so you have to find a way to make one of those come, and then they attract the others. So.
Yeah. How long did it take you to decide to formally start working with Chris and Andy at Founders Co-op?
It was a while, because I was enjoying my angel, the way I was doing it as an angel, yeah. But then, it occurred to me, I'm not scaling, I'm not having the impact I could. And Chris and Andy, and I've known them for a long time because I was an investor in the previous fund. We talked a lot about, what our vision is for Seattle and the Northwest and what it could be, and honestly where the investment opportunity lies. There's actually a very interesting arbitrage between Seattle and the Bay Area, in that, if you can find good seed deals in Seattle and invest in them at, not valley prices, then if you're sufficiently connected down in the Bay Area, hopefully the ones of those that are successful, you can take them and get significant up rounds, right, and more valley-style valuations. And so it's almost like an arbitrage that we have from an investment standpoint.
It's got a bit of a discount in Seattle.
Yeah, exactly. That's right. There is, and so yeah, I think both from an investment standpoint and from a sort of civic, philanthropy kind of standpoint, we have a lot of ideals in common.
Yeah. And how long have you been in their funds? Just those?
Well, we just did our first close a couple weeks ago, so it's, formally for a couple of weeks.
But before that, you were in the fund.
Oh, I was in the previous fund. Yeah, I think whenever they raised it, 2011 or 2010.
Okay. Yeah, so a couple years.
Yeah.
What has been your biggest investment success so far?
Yeah, it depends on how you look at it. So I had an exit with Spark, which it's undisclosed, but it was positive. I was happy with the return, which was sold to Yahoo recently. I've had a couple that have done significant up rounds, sort of Java Line and OfferUp and Gratify. There are several that have done up rounds, which of course, while not an exit and not liquidity, it's a good sign.
It's going in the right direction.
Yeah, exactly right. So yeah, I'd say as with most things, there's a bell curve, and some are probably not going to make it, and some hopefully will be big hits, and your big hits will carry the ones that didn't make it.
And what if you could tell us a story, the first time you met a founder, and you don't have to name a name, but tell us a story that the first time you met a founder, and from that meeting to say today is the biggest surprise. Like I met this guy, this is what I had in my head with him, I thought he was going to do this, and now it's 1 year later, holy, wow, where'd that come from?
Yeah, certainly, in my earlier days before my radar was as sharpened, it's actually a fairly common thing, right? And especially what happens is founders who are more salesy or don't have technical background are prone to make paperwork kind of promises. Unfortunately, they're like, oh, it's going to be awesome, we can build this, that, and the other thing. But if you don't have a technical team that can actually deliver on that, then yeah, right. And so you got to learn to sort of take that with a grain of salt, and that's where digging into the technology and the technologist really becomes important. But yeah, it's not one specific person. It's actually a fairly common story that we find.
So if you were going to give everyone in this room advice on that piece, not talking about vaporware, et cetera, what would that piece of advice be? Talking to an angel investor, you or whoever?
Yeah, it's you want to put your best foot forward, but you never ever want to be caught out on either a lie, certainly, or even an exaggeration, right? So, because the thing is, investor and entrepreneur relationships are a relationship, like a marriage. And you're going to, hopefully, if you move forward, you'll be together for a period of years. And, there has to be trust in that relationship. And so, yes, you need to sell enough to convey the vision and convey, how awesome this opportunity is. But if you start overpromising and under-delivering, your credibility, immediately starts to go down. And certainly, during the, while you're pitching an angel, if you make these extravagant claims, you better expect to, you better be backing those up, or, if once an angel or any investor really gets the sense that this guy's kind of full of it, you're done, right? You're not going to make any further headway. And so, it's much better to, you don't want to under-promise and over-deliver, but you want to correctly promise, because you have to strike the balance between selling it, but not overselling it,
Sure. And has there been someone in the last, 2 years, year and a half that you said, there's no way that's going to work, and it ended up working?
In the last few years, I've not, the problem, but one of the issues with angel investing is the feedback cycles are very long. And you don't know if you made a good decision or a bad decision for, maybe 5-10 years. And so, there have been a few, like honestly, Airbnb and Uber, although I didn't have, no, not Uber, sorry, Airbnb, although I didn't have the opportunity to invest in it. When I first saw it, I was like, really? I was like, no way, this thing, because it doesn't make any sense, because there's already hotels out there. And so, who needs to live in some guy? But what I didn't appreciate is that there's a qualitatively different experience in living in somebody's apartment than there is living in a hotel. So that one I would have missed, even if I didn't have the opportunity to invest.
But even if you
I would have been like, nah, forget it.
What's the kiss of death when they're talking to an angel investor, describing their opportunity? Not necessarily your kiss of death, but like just in general, what would you say? Don't do this outside, of course, lying.
Yeah.
But what would be the thing that you would say? Here's something I just see happens a lot. It's a
Yeah.
mistake that I see. What would that be?
Yeah, it's. I think part of it is not being on the ball, right? If I have questions, like if you're pitching me, I expect you to know everything about your business, and you're fully committed, and and even if you don't know the answer, at least you have a credible reason for why you don't know the answer. If I'm asking you questions and I know more about your business than you do, that's not good. Right. So. So I think part of it is just not being prepared and not having your ducks in there. And they're typical questions that everybody's going to ask, right?
Customer acquisition costs.
Yeah, right. Who's your team? Like customer acquisition costs. Like what's the market opportunity? What's the lifetime value of a customer? Like these. And if you're not prepared to answer those, then you're not going to get too far. So.
Yeah. And of those questions you just rattle off, what do you think are the top 2 or 3 that you better know? So
it varies. Like so for enterprise companies, right? Or any company that's based on transactions, where you're selling something for price, right? The key dynamic that you have to understand is what is the cost of customer acquisition, and if it's physical products, what's the COGS, what's the cost of goods sold, and how does that compare to the lifetime value of the customer? Because that's it. That's the only thing that matters in the long run, right? Yeah, and so you better have a handle on, okay, what is our marketing plan? What's our distribution strategy? Is it a channel strategy? Are we going to go direct? Is it Facebook ads? Whatever, right? And how much is that going to cost, right? And then you need to make a credible argument that whatever that costs, it's a lot less than here's the lifetime value of the customer that I'm acquiring. So that's for transactional companies. For companies that are based on sort of growth and engagement and advertising, it's how are you going to, you can't afford to pay anything if you're making pennies per user. You can't afford to pay anything to acquire these users. So you need to find a way to, make that sort of hockey stick in growth and engagement happen, virally or through distribution partners or something that doesn't require you to spend money to acquire these. So you have to be able to answer that question as to how that will happen.
Yeah. And in your, experience, the people that you've invested in, I assume the better founders, what have they done different than the ones that you didn't invest in? Like, what were the keys to them just saying, you're like, yeah, this is the guy?
Yeah, part of it is it's crisp, they're not scattered, they have a very focused idea on, okay, here are the steps we're going to take. It's not like, I've got this great idea and it's a Swiss Army knife and we can do 1 million things for 1 million people. Like, I want to know, what is that killer thing you're going to do that is so much better than, substitutes out there that people are just going to be like, I need to have this thing. That's by far the most important thing. And of course the team has to be strong and those, but in terms of the idea that they pitch, I want to see something that is qualitatively like orders of magnitude better than competing solutions, or maybe it doesn't even exist, right? There's nothing like this anywhere.
Right.
That kind of thing is much more compelling than we're a slightly better version of this, we're going to cut costs by 10% or something like, that's much harder to say.
We're 10% better than Google.
Right, exactly right.
What was one of your favorite experiences for the first time meeting with a company founder?
The first time, I haven't done any pretty junket, kind of, flying on a plane kind of stuff. So it's been mostly when I see somebody who's just very enthusiastic. They clearly have thought about it. It's very plausible. And I love to see companies that have bootstrapped their way to some level of success, because it shows me they're scrappy. It shows me that they're going to be frugal with money. It shows me that they can build a team just based on their passion. And so my favorite experience, it's not like hey, we had drinks and then went to Vegas, kind of experience. But it's more like it's more like okay, this person came across and I genuinely believe, and in my mind, subconsciously, I'm comparing every entrepreneur I meet to Jeff Bezos and Mark Zuckerberg, because I saw both of them up close, and they're about as good as you get, right? And so consciously or subconsciously, I'm like, do these people stack up to Jeff and Mark? And so when I see a founder who is sort of heading into that level, I'm like, awesome, that's great. That's the thing that is the most interesting.
And I'm going to guess you make a decision pretty quickly.
Yeah, I do. Yeah, it's pretty quick. I don't think it serves anybody to drag things out and be like, oh, maybe, it just wastes the entrepreneur's time, it wastes my time. It's just, quick, as they say, a quick no is the second best answer. Right?
Yeah. Much rather have that than slow yes.
Yeah.
Or slow maybe.
Yeah.
What's the one thing an entrepreneur should never say to you in a first meeting? What should they never say to you in the first meeting?
Yeah, it's probably something, anything that seems like just sales BS, right? It's like, we're gonna displace Google, like, great, okay, good for you, like, we're going to, anything that just sounds like it just can't be substantiated, like, come on, like, if you damage your credibility like that, then that's, obviously not gonna work too well. So.
And all your, we talked a bit about, how do you keep up on technology. What are like, if you could, again, give the audience 2 or 3 things that can help them stay abreast of what's going on within the industry, what would you say those 2 or 3 blogs and or whatever's to read? Yeah,
I mean, the tech industry broadly, right? I mean, you want to read Tech Meme and Panda Daily and maybe Reddit, and then GeekWire for the local stuff.
VCs to follow, Fred Wilson's?
There are, but I don't tend to follow them. But yeah, I know a lot of people put stock in sort of Ben Horowitz and Fred Wilson and people like this. And so while I don't myself read a whole bunch of it, I know that a lot of people derive value from that. Sort of Brad Feld and people like that. So.
Yeah. And do you now call yourself a VC?
I guess, yeah. It's just even though founders co-op, I'm essentially looking at the same kinds of companies I was as an angel, but technically I'm a VC. I guess.
Yeah. How's that feel?
Good. About the same.
Yeah. Okay. So before you were an angel investor, you didn't have anything that you didn't enjoy about a VC?
Oh no, I mean, VCs, there's a lot of, like unpleasant people in the venture capital business, right? And there's no getting around it, but my hope, part of the thing is in Seattle, the culture is actually much more appealing. There's not this rat race, shark elbows mentality that we have down in the valley, because in the valley, there's so much money chasing, relatively fewer deals, whereas up here it's the opposite problem, where you have more companies than there is funding, and so here, the investor culture is much more cooperative, much more collaborative. That will change, I suppose, if we got wildly successful and all of a sudden valley money started flooding in, and then you would end up with a different culture. Right now, it's actually a very collegial investor community up here. So that's actually been a lot of fun.
Yeah, because the community here is fairly small.
Yeah.
So you know each other.
Yep.
Yeah. You have drinks with each other. It's not a big deal.
Yeah, that's right.
Yeah. What things that have you seen, again, in your 70 companies that you invest in, what things have you seen that just keep you up at night? And I mean, just kind of sticks with you in the wrong way. It's like, why do I keep seeing that happen? Is there a thing that happens, a dozen times in the last year? What is that thing again? Yeah, I mean, there's a number of pitfalls, right, that happen all too frequently. One, founders always underestimate the amount of money they need. Sure. And so, a founder is too worried about dilution at the early stage is just a huge red flag, right? Because the reality is everything is going to take longer and cost more than you think it's going to. Yeah. Almost by definition, to be an entrepreneur, you have to be optimistic, right? But the reality is, I've seen demonstrated over and over, is it always takes longer, always costs more. And so if I see a founder who's like, well, I'd love to take another 250 grand, but the dilution, I'm like, you just have your priorities all wrong. Like, a large piece of a non-existent pie is not going to, not going to be all that rewarding for you. You'd much rather have a smaller piece of a bigger pie. So. Yeah. And so your philosophy is, when the money is available, you take it? Yeah, within reason. Yeah, sure. Yeah, I think that's all. Because the thing is, especially in Seattle, where a market downturn can really hammer us. Whereas in the Valley, you might still be able to get funded even in a nuclear winter, like a 2008 style, kind of scenario. Up here, forget it. Nothing's getting funded in 2008, 2009. And so, in Seattle especially, I mean, you're much better off with taking money when you can raise it on, even if the terms are not ideal or it's a little more than you wanted, you're almost always better off taking the money. Yeah. And, again, advice for, maybe first-time founders or founders. Describe how you would negotiate with a founder. What is a normal deal? Yeah, I mean, I'm very market focused, really. I mean, because really, investing and valuations are based on what the market will bear, and what can you raise money at, and so in Seattle for at least the last few years, there's been a sort of fairly typical range where sort of credible team
with an idea, but no product out yet, the valuation there is probably between $0 and $2 million, something like that. A credible team that has a product but hasn't really gone to market, maybe they're in beta or something, that valuation is sort of between $2 and $4 million. And then a credible team that has the beginnings of traction, they're showing some proof points, that's sort of 4 to 6. And then if you have a credible team and they've got a product that's out in the market that's letting it, the sky's the limit.
Yeah, whatever it is, it is.
Right. But there's a fairly well-defined market in Seattle. And that's what the market will bear, and so typically when I talk to an entrepreneur, I say, I'm very honest with them, and I say, look, here's what the market will bear, here's where the stage your company's in, so here's a valuation I would propose based on that.
Yeah. And again, in an angel round, what percent is more normal than not? That a group of you, me, and 3 or 4 other guys invest in a company.
Yeah.
What would we be expecting?
Yeah, typically, between 20 and 30% is kind of the typical thing. I don't see a whole ton of angels trying to, and it's actually, I don't like this when angels try to layer on a bunch of preferences and sort of, because it just causes huge problems down the road in terms of founder motivation, and then later investors see that as a signal and they want even more and stuff. And so, I would, if I were a founder, unless I was in some unusual circumstance, stay away from anybody who's trying to, I want a 3x liquidation preference on top of, that kind of stuff. And you don't see that as much. That was more common in the .com days where people really try to jam people. But I think, now if you get a nice clean, 1x, or it's a note, that converts at a reasonable cap, that's fine. But, the people who get really greedy at the early stage, that's money you probably don't want.
You don't want to invest that money.
Right.
And talk a bit about, are you a fan of convertible notes? Are you not a fan? Are you?
I am up to a point, so up to about $1.5 million, I think convertible notes are essentially fungible with price rounds.
And explain so everyone can understand, what's a convertible note?
Sure, so a convertible note, there's 2 ways you can raise money. Either sell stock in your company or issue debt. You say, okay, I'll pay you back at some future date in exchange for your money now. Convertible debt is debt that, upon the occurrence of some event, will convert into equity. So it takes the debt off the books, but dilutes you on the stock front. And so, the typical convertible note is one that says, okay, I'm going to raise $1 million, in the form of debt, but that debt will convert into equity upon a couple of typical scenarios. And then almost always professional investors will insist on some sort of cap on the valuation.
Yeah, 3 million cap.
Yeah, right, at which, because in order to take the risk at a very early stage, if the thing actually is really successful, you want to be rewarded for that risk.
Yeah. So, not to interrupt, so are you a big fan of convertibles, not convertibles?
Oh, yeah, so in terms of, up to about 1.5 million, I'm indifferent. It's fine, I think it's actually faster, cheaper,
It's
easier.
easier,
Yeah, right, but, as long as it's got a cap, you're essentially pricing around, so that part isn't, that different, but just you don't have to spend as much in legal fees, and it's not...
Easier for all parties.
Yeah, it is, but the thing is, once, you don't want to start layering too much debt on a company because, 2 things happen, one, certain types of financing and certain types of investors won't, downstream won't invest if the company has too much debt on the books because they're afraid the money will go out the door to the debt holders before they can, they won't put money in on the equity front, or sometimes, problems like equipment leasing and things if there's too much debt on the books. And then 2, especially if there's a cap, it leads to tough discussions with your next funding partner because, so these early people, they get in and they get 3 times the liquidation preference because the whole thing turns into, and so beyond a certain point, I advise entrepreneurs just price around and clear the debt out of the books, but up to about $1.5 million, I think it's fine.
Makes sense, yeah. So let's open up for some questions. In the red.
I'm waiting for the punchline on your Pets.com t-shirt.
So we're moving houses, and so I was digging through some of my old Amazon swag, and way back in '99 or '98 or something, we had to deal with pets, and I thought, I'd wear it to this. It's an instructional reminder of how things can go. Anyway.
Go ahead.
Hi, I'm standing now. Okay, so your new goal with Founders Co-op, you said it makes you a slightly more conservative investor, and I'm wondering if that kind of stands in stark conflict with your philanthropic goals of risk aversion and a more thriving
Yeah, it's not necessarily that I'm more conservative, it's that I'm more selective, I guess, and so in some ways I'm actually being, I guess you could look at it as less conservative, because now I'm only betting on companies that could potentially return the entire fund. These could be like gigantic winners, right? Whereas as an angel, I might do it just because I like the entrepreneur, I want to help, like a particular space, or, I could make a 3x return and be fine, So now I'm going to be doing a smaller number of deals, but they have to be deals that could be gigantic winners. And I think from my standpoint, from a philanthropic standpoint, while I lose, this benefit of funding a ton of entrepreneurs, I gain the benefit of hopefully making money for a ton of angels. And so, from that standpoint, if those people make some money in the tech business, hopefully my hope is that they'll be incented to plow that money back into the local ecosystem.